Welcome back to the Daily Crypto Roundup, and today we've got one of those episodes where the market is not just about price action, it is about trust. We've got a major $292 million crypto hack exposing the weak spots still sitting inside DeFi. We've got Bitcoin developers warning about what they are calling a hazardous airdrop connected to Paul Sztorc's eCash fork idea. We've got a Canadian pension giant buying the dip in strategy and already sitting on a reported $69 million unrealized gain. And then we've got Ethereum right at the center of the market again, with whales buying hundreds of millions of dollars worth of Ethereum, while the Ethereum Foundation sells another 10,000 Ethereum to BitMine. So before we get into the individual stories, the big theme today is simple. Crypto is maturing, but the stress points are becoming clearer. Institutions are buying Bitcoin exposure. Ethereum whales are accumulating. But at the same time, DeFi security, treasury transparency, and fork risks are still major questions hanging over the market. At the time of reporting, Bitcoin was trading around $78,300. Ethereum was holding around $2,300. XRP was around $1.39. BNB was around $617. Solana was around $84. Cardano was around 25 cents. Chainlink was around $9.12. Toncoin was around $1.34. The market is not exploding higher today, but it is not falling apart either. It feels more like a market waiting for confirmation, with capital quietly moving underneath the surface. Before we get into it, this episode is brought to you by Kraken. If you're looking for a simple and trusted place to buy Bitcoin, Ethereum, Solana, XRP, or other major crypto assets, check out the Kraken link in the description. Kraken is one of the most established names in crypto, and using our link helps support the show as we continue bringing you daily crypto news, market analysis, and deep dives. As always, only invest what you can afford to lose, and never keep more on any exchange than you're comfortable with. And if you sign up with our link, we will drop 20 XRP into your new wallet. Just message us once it's done. Let's start with the DeFi hack, because this is the story that should make the whole industry uncomfortable. A $292 million crypto hack has exposed DeFi's weak spots, with industry insiders saying the sector now needs stricter baseline safeguards, zero-trust architecture, stronger collateral controls, and more institutional-grade standards. And that is the important point. DeFi cannot keep asking for institutional money while operating with retail-grade security assumptions. The promise of DeFi has always been open access, transparency, programmable markets, and removing the need to trust middlemen. But the problem is, if smart contracts, bridges, collateral systems, admin keys, or governance controls are weak, then users are not really removing trust. They are just moving that trust into code, multi-sigs, or anonymous teams. This is where the story gets bigger than one hack. Every major exploit chips away at confidence. It does not just hurt the protocol that gets hit. It makes institutions ask whether DeFi infrastructure is ready for serious money. If a bank, fund, pension manager, or corporate treasury looks at a $292 million exploit, they are not thinking, that's just one protocol. They are thinking, what happens if this is connected to something we touch? And that is why the language around institutional-grade standards matters. DeFi needs better auditing, better monitoring, better risk segmentation, better emergency controls, and much clearer disclosure around who can change what inside a protocol. The old crypto culture of move fast and let the market figure it out does not work when hundreds of millions of dollars can disappear in one exploit. If DeFi wants the next wave of capital, it needs to look less like an experiment and more like financial infrastructure. This episode is sponsored by Kraken. Kraken is one of the best-known names in crypto, and if you are looking for a serious platform to buy, sell, and manage your crypto, check the Kraken link in the description. As always, only invest what you can afford to lose, but if you are getting serious about crypto, using a trusted platform matters. Now let's move to Bitcoin, because this one is technical, but it is important. Developers and industry figures are warning against Paul Sztorc's eCash fork proposal. describing it as a hazardous airdrop that could introduce user risk, uneven distribution, and philosophical tension inside Bitcoin. The core issue here is not just whether a new fork can exist. Bitcoin has had forks before. The issue is how users are being exposed to risk. When you create a fork or airdrop connected to Bitcoin ownership, you can create confusion around keys, wallets, replay protection, claims processes, and custody. Ordinary holders might not fully understand what they need to sign, move, prove, or expose in order to claim anything. That matters because Bitcoin's strongest value proposition is security through simplicity. Bitcoin is meant to be boring in the best possible way. You hold your keys, you know the rules, you know the supply. You do not want people creating complicated claim systems where holders could accidentally compromise themselves. So when developers warn that something is hazardous, the market should pay attention. There is also a philosophical issue. Bitcoin's culture is very different from Ethereum's culture. Ethereum is more experimental. It evolves faster. It accepts complexity more easily. Bitcoin is more conservative by design. So, when a proposal feels like a complex airdrop layered around Bitcoin ownership, it clashes with what many Bitcoiners believe Bitcoin should be: stable, cautious, predictable, and extremely hard to manipulate. That does not mean innovation around Bitcoin is bad. Far from it. We are seeing growth around Bitcoin layers, custody tools, institutional products, and even quantum resistance debates. But the lesson is clear. Anything that touches Bitcoin's holder base needs to be extremely careful. Bitcoin's market value is built on confidence, and confidence is built on not making users do dangerous things with their keys. Now to the institutional side of the market, and this is where things get very interesting. Canadian pension giant AIMCo purchased 1.38 million shares of Strategy in the first quarter for around $172.5 million, with the stake now reportedly sitting on a $69 million unrealized gain. This is a massive signal because Strategy is not just a normal equity story anymore. Strategy has effectively become a leveraged institutional Bitcoin proxy. When major asset managers, pension funds, or institutional investors buy Strategy shares, they are not just buying a software company. They are buying exposure to Michael Saylor's Bitcoin accumulation model. And that matters because it shows how Bitcoin exposure is being packaged for traditional finance. Some institutions may not want to hold spot Bitcoin directly. Some may face mandate restrictions. Some may prefer equities. Some may want a familiar wrapper. Strategy gives them a way to express a Bitcoin view through the stock market. The $69 million paper gain is also important psychologically. Institutions watch what other institutions do. If a pension manager buys the dip and quickly sits on a large unrealized gain, that becomes part of the broader institutional narrative. It says Bitcoin-linked equities are not just speculative retail plays. They are becoming serious allocation vehicles for large pools of capital. But there is risk here as well. Strategy's upside comes from Bitcoin exposure, but so does its downside. If Bitcoin falls sharply, Strategy can fall harder. So this is not a risk-free institutional endorsement. It is a sign that some institutions are comfortable taking amplified Bitcoin exposure. That is bullish for sentiment, but it also means Bitcoin's volatility is increasingly tied into traditional portfolios. Now let's turn to Ethereum, because Ethereum has two stories today that sit almost opposite each other. On one side, whales are buying aggressively. On the other, the Ethereum Foundation is selling again. According to Crypto.news, Ethereum whales added more than 140,000 Ethereum coins in 96 hours, worth around $322 million, while Ethereum traded near $2,300. The report said whale holdings rose from around 13.78 million Ethereum to nearly 13.98 million Ethereum between May the 1st and May the 3rd. That is not small money. That is steady accumulation while the price is fairly quiet. And that can matter because whales often build positions before the broader market notices. It does not guarantee a breakout, but it tells you large wallets are not running away from Ethereum at this level. Technically, the key level is still around $2,200. If Ethereum holds that area, the market can argue that the recovery structure remains alive. A clean move above $2,400 would be more meaningful, because that could open the path toward $2,600 and then $2,800. But if Ethereum loses $2,200, the risk is that price drifts back toward the $1,900 area. So Ethereum is in an interesting zone. Whales are buying, but the chart still needs confirmation. The market is not yet screaming breakout. It is more like accumulation under resistance. And then we have the Ethereum Foundation story. Crypto.news reported that the Ethereum Foundation sold another 10,000 Ethereum to BitMine at an average price of $2,292 per coin, making the deal worth around $22.9 million. This was reportedly its third over-the-counter sale to BitMine in 2 months. The foundation said the sale supports core operations, protocol research, ecosystem work, and community grants. That is the reasonable side of the story. Foundations need funding. Developers need support. Ethereum's ecosystem does not maintain itself for free. Research, client development, validator tools, privacy work, education, and infrastructure all require money. But the criticism is understandable as well. When Ethereum is trading around $2,300 and the foundation repeatedly sells Ethereum, some holders see that as pressure on sentiment. They ask why the foundation needs to sell this much, this often, and why treasury management is not communicated more clearly. The debate became even sharper because the foundation also recently unstaked 17,035 Ethereum, worth around $40 million. No official statement linked that unstaking to a market sale, but the move still raised questions among traders watching foundation wallets closely. So Ethereum now has a split narrative. Whales are buying hundreds of millions of dollars worth of Ethereum, which looks bullish. The foundation is selling Ethereum to fund operations, which is not necessarily bearish, but it does create optics issues. And that is the real tension. Ethereum has strong long-term infrastructure, deep developer activity, and institutional relevance. But it also has a community that wants more clarity from the organization sitting closest to the protocol. So the takeaway today is this. Crypto is not short of demand. Bitcoin-linked equities are attracting pension money. Ethereum whales are accumulating. But the industry still has to clean up its weak points. DeFi security has to improve. Bitcoin forks and airdrops have to avoid putting users at risk. Ethereum's treasury decisions need clearer communication. The next leg of this market will not just be decided by prices. It will be decided by whether crypto can prove it is secure, transparent, and mature enough for the capital it wants to attract. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.